investing, successful investing is all about. And the first point is know what you own. I can't believe how many people own stocks and they couldn't describe to an 11-year-old in 2 minutes or less why they own this thing or what it is. If you actually pin them down and you put a whip to them, they'd say the sucker's going up. That's the only reason they have for,
Can average people like us really take on Wall Street and win? Now, I know what you might be thinking. Wall Street is a giant filled with experts and big money, right? But here's the best part. According to investing legend Peter Lynch, the answer is a big fat yes. In his book, Beating the Street, Peter Lynch is laying down a roadmap for how everyday investors can actually outsmart those fancy Wall Street fund managers who play around with stock portfolios like it's a game of chess. And Lynch himself has smashed the market time and again, showing us that with the right strategies, we can too. Now, if you're sitting there wondering, can I really do this? Well, why not? With Peter Lynch's strategies, we're learning how to play the game by its own rules and beat Wall Street at it. In this video, we are going to show you some valuable strategies from Peter Lynch to beat Wall Street at their own game. And hey, if you're new here, hit that subscribe button and ring the bell icon. You don't want to miss out on the gems we're dropping here to help you navigate through the investing jungle. Stick around and let's beat the street together. Alright, diving right into the next way Peter Lynch teaches us to outsmart Wall Street. He brings all his insights from those powerhouse years running the Magellan Fund at Fidelity. Peter's got a pretty straightforward message for us. All the info we need to succeed in investing is out there. But here's the catch. You've got to be willing to roll up your sleeves and work hard to make sense of it all, turning it into smart, timely investments. Alright, so Peter Lynch emphasizes on 3 strategies. And we are going to break down these strategies further, taking a closer look at how Peter Lynch suggests we can hold our ground and even thrive in the stock market jungle. So let's kick things off with the first major insight from Peter Lynch on how to beat Wall Street at its own game. Strategy 1. Beware of bonds, trust in stocks. We're talking about why, despite the common belief that bonds are safer and less headache-inducing, stocks are actually where it's at if you're aiming for bigger, better returns in the long haul. First up, let's break down how bonds work. Imagine you're buying a $1,000 bond. What you're actually doing is lending money to the entity that issued that bond, be it a corporation or the government. In return, they promise to pay you back with interest. Say your bond has a 5% interest rate. After a year, you'd get your $1,000 back plus $50 in interest. Sounds simple and safe, right? Well, not so fast. Here's where Peter Lynch points out the catch. Bonds might seem like a cozy little investment because they promise that fixed payment, but they've got some sneaky risks. The first biggie is inflation risk. Imagine inflation is at 3%. That means everything gets more expensive and the buying power of your money goes down. So, that $50 you earn in interest doesn't stretch as far as it did a year ago. Essentially, inflation can eat into what you're really earning off those bonds. Then there's the risk from interest rate changes. Bonds have this quirky trait where their prices go down when new bonds come out with higher interest rates. So if you need to sell your bond before it matures, and interest rates have risen, you might have to sell it for less than you paid. Now, why does Lynch champion stocks over bonds? He's not just playing favorites, he's got the stats to back it up. Over time, stocks have not just performed well, they've outperformed bonds by a significant margin. Why? Stocks are shares in a company. When you buy stocks, you're not just lending money, you're buying a piece of that company. And this comes with potential perks like dividends, and of course the chance to benefit from the company's growth, which can lead to your shares increasing in value. So, while stocks might give us a bumpy ride sometimes, Lynch's point is clear. If you're looking for real growth, trusting in stocks over bonds is the way to go. He stresses that this is a long-term game. Sure, in a bad year, bonds might outshine stocks, but over decades, stocks have consistently been the winning horse in that race. That's the kind of insight that can help us beat Wall Street at its own game, thinking long-term and opting for the bolder, broader growth that stocks can offer. All right, friends. Let's dive into another key insight from Peter Lynch on how to take on Wall Street and come out ahead. Strategy 2. Selecting and managing your stocks. Now that we've seen why stocks tend to be a better long-term bet than bonds, it's time to get into the nuts and bolts of building a successful stock portfolio according to Lynch. Peter Lynch has always been a champion of the idea that regular people like us can pick stocks just as well, if not better, than the professional portfolio managers. But let's be real, this isn't a walk in the park. It involves digging deep into the financial and market fundamentals of the companies you're thinking about investing in. And once you've picked those stocks, managing your portfolio effectively is crucial. Lynch advises against spreading yourself too thin over too many stocks that you can't possibly keep tabs on all of them. Instead, focus on a manageable number of investments and really get to know them inside out. Understanding the fundamentals is key. Every stock you buy represents a piece of a real company with its own story. Its management, employees, products, services, and strategies. When you buy a stock, you're not just hoping for the best. You're making an informed decision based on solid research. Lynch isn't about gambling, he's about investing with knowledge and insight. He even used to visit company headquarters and meet with executives to really understand their operations and growth plans before he decided to invest. Managing your portfolio effectively is next. Here's where Peter Lynch really drills down on some core principles. First off, don't overload yourself with too many stocks. It's better to have a smaller number of investments that you can truly focus on. Regularly reviewing their performance is crucial. Keep an eye on those quarterly earnings, balance sheets, and other key financial metrics. This ongoing analysis will help you figure out which stocks are set for sustainable growth and which ones might be on a downward spiral. Diversification is another cornerstone of Lynch's strategy. He stresses the importance of having a well-rounded portfolio with stocks from various sectors. This protects you against losses in one area being catastrophic, as they might be offset by gains in other areas. History has shown time and again how risky it can be to put all your eggs in one industry basket, like tech stocks in the early 2000s or cryptocurrencies recently. And finally, play the long game. The stock market is going to have its ups and downs. These are inevitable. Market downturns can be tough, and they're often caused by factors beyond any individual investor's control. But Lynch sees these downturns not as disasters, but as corrections, opportunities to pick up valuable stocks at a discount. It's these moments, if navigated wisely, that can set you up for substantial long-term gains. So, to sum up, Peter Lynch's approach to beating the market is about smart selection, diligent management, and strategic patience. By adopting these methods, Lynch teaches us how to not just survive in the market, but to thrive and outperform those Wall Street pros. Now, moving on to the next method Peter Lynch shares on how to beat Wall Street, we have Strategy 3, the case for index funds. Lynch gets it. Not everyone wants to or has the time to manage their stocks closely. That's where stock funds, and more specifically, index funds come into play. A stock fund is basically a pool of money collected from many investors, just like us, to invest in a portfolio of stocks. When you buy into a stock fund, you're buying shares of the fund itself, not the individual stocks. This means you're letting professional fund managers handle the selection and management of stocks, which saves you a bunch of time and effort. But here's a twist. Peter Lynch points out that while stock funds are handy, they often come with high management fees that can eat into your returns. Plus, many of these funds don't consistently outperform the market. That's why he's a big advocate for a specific type of stock fund, the index fund. Index funds are designed to replicate the performance of a specific market index, like the S&P 500 or the Dow Jones Industrial Average. These funds are straightforward. They simply buy the stocks that make up the index they track, in the same proportions. So if a company makes up 3% of the S&P 500, it'll make up 3% of the index fund's portfolio. This approach has a couple of big pluses. First, it's passive, meaning there's less frequent buying and selling, which keeps costs low. Second, you're diversified right off the bat, as these indexes cover a broad range of sectors and companies. Lynch notes that there are various types of index funds tailored to different investment needs. You've got your market cap index funds, which are categorized by the size of the companies they invest in. There are large cap funds focusing on big, established companies. These are generally seen as more stable. Then there are mid-cap and small-cap funds, which involve smaller companies that might be riskier, but also offer the potential for higher returns. Then there are sector-based index funds. These funds target specific sectors of the economy, like technology, healthcare, or consumer goods. Investing in these allows you to bet on the growth of certain industries without having to pick individual stocks within those industries. For instance, if you're bullish on technology but unsure which tech stocks to pick, you can invest in a tech-focused index fund and get exposure to the whole sector. Lastly, there are regional index funds, which invest in companies based in particular parts of the world. This can be a great way to diversify internationally. If you think Asia's markets are set to boom, you can invest in an Asian market index fund. Or, if you want something less volatile, you might opt for a fund that focuses on North American or European companies. All these options mean that investors can find index funds that match their specific goals and risk tolerance. This makes index funds a powerful tool in our quest to beat Wall Street. They allow us to benefit from the general upward trend of the markets, avoid high fees, and keep things simple without sacrificing performance. According to Lynch, that's a winning strategy for the long haul and a savvy way to play the investment game. And there you have it, some expert tips from Peter Lynch on how to beat Wall Street at its own game. If you found this video helpful, don't forget to hit that subscribe button. Join our channel here to keep up with more insights and strategies that could help you get ahead in the financial game. Your journey to smarter investing is just beginning, and we've got plenty more wisdom to share. Thanks so much for watching, and we'll see you in the next video. Until then, keep studying your investments and making smart choices. Happy investing!